Hello and welcome to Macro Pulse. Earlier this week, we had the Finance Minister Enoch Godongwana deliver the budget after it was postponed on the 19th of February due to disagreement between the GNU parties on the 2% VAT hike that was proposed. This budget, the numbers didn't look a lot different to what was initially proposed in the February version, and that is potentially where the good and the bad of this budget comes in. On the positive side, there is still a firm commitment towards fiscal consolidation. We see that the debt to GDP is estimated to peak now this year at 76.2%, that the primary budget surplus remains in positive territory and rising over the next few years, and we see that the debt deficit will be falling from about 5% currently to 3.3% over the next few years. This budget, they didn't choose to increase debt, to issue debt, to finance new spending. They rather, and this is where the negative side comes in, choose to look at the revenue side and increase taxes to fund the additional spending. And in particular, if you can recall, there was a 2% VAT hike proposed at the February version, and this week they proposed to have a 0.5% VAT hike for this year, starting on the 1st of May, and then an additional 0.5% next year, bringing the overall VAT rate from 15% to 16% by next year. Now, not only that, but also if you look at the income brackets, hasn't been adjusted for inflation in this version, whereas in the previous version, we did see some adjustment for bracket creep in the February version to offshore and to cushion some of the impact on the low-income consumer. So the combination of both the VAT hike as well as the non-adjustment of the tax brackets does imply that consumer pockets will be hit harder this time around. So this is not in particular a very strong growth budget. Rather, the focus on fiscal consolidation is a positive. So if we think about the equity market, it's probably less equity friendly and a little bit more bond friendly. Bond investors will still like to see this fiscal consolidation play out. On the spending side, we also see some adjustments. The February version relative to this version, we saw a reduction in proposed spending. The reduction in spending is coming particularly from frontline services, so less money towards home affairs. We also see that there's a reduction in the contingency reserve as well as in social grants, although social grants continue to grow at a rate above CPI. On the positive side, we saw that the money towards infrastructure spend remains in place, and so that growth boost remains within the economy. But public sector wages, as well as the SRD grant, also remains the same. The challenge now is that both the parties within the GNU as the opposition parties are opposing this budget on the basis of the VAT hike. ANC currently sits with about 40% within Parliament, and they would need another 10% to get the budget across the line, to get approval of this budget. So what happens next? There's about 3 weeks in which the parties can get together and amend the budget to get to the 50% approval. And there are a few options here at the table. One is the ANC goes with opposition parties like the MK and the EFF, and then have to introduce what their proposal is, which is a corporate income tax hike or wealth tax, which we think is probably at this stage a lesser chance of playing out. The second option is that the ANC and the DA and other GNU parties get to some sort of a road forward, which may include concessions by the ANC to the DA on maybe some non-fiscal issues, or a concession that the DA could implement a much more aggressive spending review of the budget, whereby potentially the 0.5% VAT hike is allowed for this year, but the one for next year could potentially be reviewed or taken off the table completely. However, thus far, the GNU has worked, although not all parties within the GNU understands how it is supposed to work. We think that ultimately this budget will have some implication for the SARB as well. The SARB is supposed to meet next week, and with the increase in VAT, estimations are that we will see an increase in the inflation rate of about 0.2% this year as well as next year, which means that average inflation for this year will be around 4% and maybe slightly above 4.5% next year. So this increase in inflation, together with the uncertainty still around the GNU and who will vote and when will vote for this budget, probably means that the SARB will not cut rates next week at their meeting and will choose to hold rates until there's more certainty in the market. You would recall that overall, you still believe that the SARB will cut more than the market is expecting at this stage, but that is more due to the fact that we see a slowdown in the US potentially playing out. Let's move on to the global side and see what's happening in global markets. The investment theme for the last few years has been US exceptionalism, but we've been argued for the last few months that that theme will get challenged. And as we look into the beginning of this year, we saw that valuations were quite high, expectations for growth was quite high, and investors has positioned very heavily towards the US. More recently, we've started to see that economic data in the US is starting to weaken, and we've started to see a lot of policy uncertainty emerging, specifically around tariffs and around the fiscal side, in particular how DOGE will cut government spending and the impact that would have on government workers and government agencies, but also on agencies and aid around the world. This uncertainty ultimately means that investors are not willing to spend. They're more willing to save, and that companies are not willing to invest now and lay out capex towards the economy. So what we see now is a market correction. We see the S&P 500 down almost 10%. We see the Nasdaq has dropped more than 10%. The Magnificent Seven, since its peak at the end of last year, is now down almost 20%, so almost in a bear market territory. But in other parts of the world, in Europe and the US, equity markets have held up a lot better. They're also down, but much less so. And in China, we see, for instance, that the equity market is roughly flat over the same period that you had the S&P 500 drop about 10%. So the question now is, what will stop this market recovery? And there's three things that I think is important here before we will see a turnaround in this market again. And the one is, we will have to see potentially an improvement in the macro data. So economic activity have to start to improve in the US. With that, also, we have to see a further reduction on the inflation front, because that will mean that there's more scope for the Fed to potentially cut rates. So the macro side has to start to improve. And at this stage, we're not seeing that yet. We also have to see potential improvement on the policy side. And on the policy side, as I said, typically it is the Fed that steps in and provides policy support towards the economy. But in this cycle thus far, inflation has been sticky and a little bit uncomfortable, which means that the Fed probably don't have that scope at the moment to cut interest rates. On the other side of the policy spectrum, we probably need to see policy certainty from the tariffs and potentially from fiscal and DOGE. And we're probably unlikely to see that in the short term playing out. The third thing is just technicals, that investor positioning, which was heavily positioned towards the US, has to fly out a little bit more, and valuations, which has been quite high, remain somewhat elevated, although we did see some decent payback of valuations over the last few weeks. So we believe there's a little bit more downside towards this economy playing out. But the US exceptionalism theme isn't just about the US and that the US is slowing down and that there's US uncertainty. It's also about what's happening in other parts of the world, and we're seeing some major positive catalysts playing out there. In particular, in Europe. We had the German election a few weeks ago, and with that victory, we saw an increased willingness to use fiscal spending to boost the economy. Just last week, we've heard about a proposal for a 500 billion euro infrastructure package, which Germany wants to bring into the economy. Also, they're talking about potential reforms of their debt brake, which will allow them to spend more in the economy and to increase defense spending as well. And if you compare Germany to the rest of Europe or to other G7 partners, Germany's debt to GDP is sitting at about 62% debt to GDP, whereas its partners, its peers, is sitting at 100 or slightly above 100. In the US, 120, and Italy a lot higher. Even in the UK, it's above 100 or close to 100. So Germany has a lot of fiscal space to improve and to boost their growth. And if they do go down that route, as per these package proposals, we may see that by 2027, the German economy could be growing at about 1.5 to 2% faster than it's growing at the moment. And that will be a significant change to what we have seen over the last couple of decades. Not only in Germany, but we've seen in Europe as a whole. There's also a proposal to rearm Europe through a package of almost 800 billion euros. The whole impact of the Ukraine-Russia ceasefire that's on the cusp of being announced will also be positive for Europe. We will see potentially energy flowing back into Europe from Russia. We could see potentially a reduction therefore in energy prices and inflation, and also as they rebuild parts of Ukraine, an increase in investment towards Ukraine. All this activity will be positive for Europe. And the reduction in energy prices and lower inflation means that the ECB will continue to have some scope to cut interest rates. In China, it's fairly similar. The policy backdrop there is also supportive. We've had the NPC meeting last week, and through that meeting we saw that the growth target remains at about 5%, that the budget deficit will increase relative to last year by about 1%, so there's a fiscal impulse that will come into the economy this year relative to last year, and there's an increase in bond issuance that will be utilized towards the property sector to stabilize the property sector, will be utilized towards domestic consumption in the form of subsidies to consumption, and we believe that this will ultimately start to improve confidence in the economy. So there's a clear intent to stabilize growth in China and potentially to improve growth. And even in Japan, where we had decades now of deflation, we're seeing increasing signs of reflation, where economic activity is picking up, wages are rising, and inflation is rising to the extent that the BOJ is on a path of hiking rates as opposed to the rest of the world where we see rate cuts playing out. All of this means that investors have to rethink their allocations towards the US, which has benefited them well over the last few years, but consider new opportunities that's arising in other parts of the world where valuations is a lot cheaper. And we believe that this diversification away from the US probably have some legs to go and will have deep implications for the likes of bond yields in the US as well as the US dollar, and which ultimately could mean a better outlook for emerging markets. However, as I said, we have to work through some weakness in the US first. It will weigh on global markets as well in the short term, and therefore investors will probably have to remain slightly more defensive in the next few weeks still. Thank you for watching.